Cincinnati Financial, founded in 1950 in Ohio, built around one simple idea: give independent agents a reason to choose you over every other insurer on the shelf.
And the way CINF earns that choice is not price. It is claim speed and field rep relationships. Agents trust CINF to show up fast when a client files a claim.
That distribution model is the whole game. These are independent agents. They are not captive to CNF. They pick the best insurer for each client, and CINF keeps winning that pick.
Over 2,000 agencies across 46 states. The network took decades to build, and it compounds. Agents who trust CNF pass that trust to the next producer in the office.
Now the headline everyone knows: 63 consecutive years of dividend increases. That puts CINF in a very small club, one of only 5 insurers in the S&P 500 Dividend Aristocrats list.
CINF's dividend yield reflects the relationship between the annual payout and market pricing. It fluctuates. What the 63-year streak actually signals is consistent cash generation and management discipline, not a particular yield level at any given moment.
Let us talk underwriting. The combined ratio for 2024 came in at 95.3%. That means for every dollar of premium collected, CNF spent 95 cents on claims and expenses, keeping 5 cents.
A combined ratio under 100 is profitable underwriting. Under 97 is disciplined. CNF has stayed below that threshold most years, even after absorbing Midwest catastrophe events.
The loss ratio was 65.8%, down almost a full point year over year. That improvement reflects both rate increases earned through 2023 and a somewhat lighter cat season.
Now here is where CNF gets unusual for an insurer. About 40% of its $26 billion investment portfolio sits in equity securities, stocks. Most P&C carriers keep equities below 20%.
That concentrated equity bet has generated massive unrealized gains over the decades. It also means CNF's book value swings more with the market than a typical insurer's balance sheet would.
Book value per share has grown consistently through underwriting cycles, reflecting the compounding of retained earnings and investment portfolio returns. CNF's equity concentration amplifies this in strong markets and works in reverse during equity downturns.
Investment income hit $1.4 billion in 2024, up 12% year over year. Rising bond yields helped the fixed maturity sleeve, roughly half the portfolio, generate more income.
Segment mix. Commercial lines are 50% of premiums, personal lines 30%. They also have a growing excess and surplus lines unit called Cincinnati Specialty Underwriters.
Cincinnati Re, the reinsurance subsidiary launched in 2013, adds another 3% of premiums. It is small but gives CINF exposure to reinsurance pricing cycles when rates harden globally.
Net written premiums grew from $5.2 billion in 2018 to $8.7 billion in 2024. That is 67% growth in 6 years, organic rate increases plus modest exposure growth in their agent network.
The catastrophe exposure is real and worth naming. CNF is concentrated in the Midwest and Southeast, tornado, hail, and convective storm territory. A bad cat year compresses the combined ratio fast.
They manage that partly through Cincinnati Re taking on some reinsurance and partly through conservative underwriting standards. The 94% net retention rate shows agents are renewing policies, not fleeing after claims.
On the leadership side, Steve Johnston ran CINF since 2011 after spending his entire career inside the company. Investment analyst, then chief investment officer, then CEO. A true insider.
He built his reputation on that equity portfolio strategy and on maintaining the underwriting culture through hard and soft markets. The dividend never got cut on his watch.
In 2025, Steve Spray is taking over as CEO. He comes up through the field operations and underwriting side of CINF. A different background from Johnston's investment focus, but still a career insider.
That transition matters. Johnston's fingerprints are all over the equity portfolio philosophy. Investors will watch whether Spray adjusts the mix or holds the same concentrated approach.
Versus peers, CNF's combined ratio of 95.3 is better than Travelers at 96.1 and Allstate at 101.2. Chubb at 88.5 is best in class, but operates in a different client segment.
On dividend yield, CNF scores highest in the peer group at 2.4%, versus Chubb's 1.4 and Travelers' 2.0. Agent loyalty and claims culture are harder to score, but CINF leads qualitatively.
CNF has compounded book value and dividends consistently across multiple market cycles. Its independent agency distribution model, conservative underwriting culture, and equity investment strategy differentiate it from peers that rely on program business or heavy reinsurance.
The key questions heading into 2025 and beyond: can the combined ratio stay below 97 through a heavier cat season, and does the equity portfolio outperform if rate cycles turn more volatile?
That's the Cincinnati Financial story. 63 straight years of dividend hikes, built on agent relationships, underwriting discipline, and a concentrated equity bet.
On the bridge, we look at how the equity portfolio shapes total return and whether the combined ratio improvement has legs after the cat year.
Cincinnati Financial traces its roots to Fairfield, Ohio, and 64 years of unbroken dividend growth later, this property and casualty insurer just delivered a quarter that reminded every income investor exactly why CNF earns a permanent spot on the Dividend Aristocrats list. Q1 2026 was Steve Spray's first full quarter as CEO, and he opened with a 10-point earnings beat.
The headline: operating earnings per share came in at $2.15 against an estimate of $1.95, a 10.3% beat on the bottom line. Revenue hit $2.72 billion versus consensus of $2.6 billion, a 4.6% top-line beat as well. Strong execution across both underwriting and investment income drove the outperformance.
What makes that beat particularly impressive is the context. Q1 2026 featured a historically active winter catastrophe season, polar vortex events, ice storms across the Midwest, February freeze events, generating meaningful losses across the P&C industry. Yet Cincinnati Financial posted a combined ratio of 96.8%, below 100, profitable underwriting despite elevated catastrophe activity.
For anyone new to insurance, the combined ratio is the primary metric in P&C underwriting. It measures losses paid plus operating expenses as a percentage of premiums earned. Below 100 means the underwriting operation is profitable on its own before any investment income. Above 100 means losses and expenses exceed premiums. The insurer lives on investment returns alone to survive.
Cincinnati Financial's 96.8 in a noisy catastrophe quarter tells you two things. First, underwriting discipline is holding under pressure. Second, the independent agent distribution model is a functioning competitive filter, keeping CINF out of the highest risk business that direct-to-consumer carriers sometimes accept to hit volume targets and satisfy near-term growth expectations.
Net written premium growth came in at 8.4% year over year, reaching $2.45 billion for the quarter. That growth reflects two tailwinds: rate increases earning through the book as filed approvals convert to renewed policies, and new business wins as agents consolidate toward carriers with strong claims reputations. Both levers were working simultaneously in Q1.
The Q1 income waterfall, total revenue $2.72 billion. Losses and loss adjustment expenses, the insurance equivalent of cost of goods, consumed $1.59 billion, leaving gross profit of $1.13 billion. Underwriting expenses of $716 million reduced that to operating income of $414 million. After $87 million in taxes, net income landed at $327 million.
There is a second engine driving Cincinnati Financial's earnings beyond the underwriting P&L, and it is one of the most important stories this quarter. Investment income reached $295 million, up 13% year over year. That growth is not coming from credit risk-taking or aggressive portfolio repositioning. It is coming from the simple math of reinvesting maturing bonds at meaningfully higher yields.
Here's the mechanics. CNF holds roughly $14 billion in fixed maturity bonds. For most of the past decade, maturing bonds were reinvested at 3 to 4% yields. Today, those same reinvestment opportunities yield 5% or better, 1 to 2 additional percentage points on every dollar reinvested across a $14 billion portfolio. That is a material and persistent income tailwind that compounds forward.
The reinvestment math generates $30 to $40 million in additional annual investment income as legacy low-rate bonds roll off and get replaced by current rate instruments. And it is not a one-quarter event. It will keep contributing for 3 to 5 years as the full portfolio cycles through at modern yields. Investment income is becoming a more reliable earnings driver than it has been in over a decade.
Beyond fixed income, CINF's equity portfolio carries over $12 billion in long-held appreciated positions, many held for decades, generating dividend income and compounding book value across cycles. That concentrated equity strategy amplifies book value in bull markets and creates paper losses in corrections. It is volatility investors need to understand and price in before sizing a position in this name.
Total assets stand at $32.5 billion against total equity of $14.4 billion, book value roughly $94 per share. Total debt is modest at $1.2 billion, leaving net debt of just $220 million. For an insurer generating nearly $1 billion in annual free cash flow against $14 billion in equity, that balance sheet is effectively unlevered by any reasonable measure.
And now, the reason income investors have owned CNF for generations: the dividend. In Q1 2026, Cincinnati Financial announced its 64th consecutive annual dividend increase. The annual rate moves from $3.36 to $3.60, a 24-cent increase, representing 7.1% growth. Every year, the check gets larger.
64 consecutive years. The streak began in 1961, before widespread color television, before the internet, before the term financial technology had been coined. Cincinnati Financial has raised its dividend through oil shocks, stagflation, the dot-com crash, the global financial crisis, COVID, and now an active winter catastrophe season in 2026. The streak has never been interrupted. That is a statement of institutional culture, not just balance sheet math.
At $148 per share, the $3.60 annual dividend implies a yield of 2.43%. The payout ratio is a conservative 34.3% of earnings, meaning CNF pays out only about a third of what it earns. That leaves ample capacity to keep raising the dividend regardless of what any single quarter's catastrophe losses look like.
That low payout ratio is structural strength that differentiates CINF from higher-yielding income names. A utility paying out 80% of earnings has minimal cushion when earnings disappoint. A P&C insurer paying out 34% has enormous cushion. Even in a major hurricane quarter that produces an operating loss, Cincinnati Financial can sustain and grow its dividend from investment income alone. The dividend is genuinely durable.
The buyback program added $30 million in share repurchases during Q1. That is modest relative to the earnings base, and intentionally so. Excess capital at Cincinnati Financial goes toward growing agency relationships, maintaining strong reserves as the premium book expands, and protecting dividend growth capacity. Buybacks are secondary to the core capital priorities. The dividend streak comes first, always.
One of the most important trends in this quarter is the improving personal auto profitability. Personal lines has been running above 100% combined ratio for 2 years as claims inflation hit the industry. But Q1 2026 data shows the personal auto combined ratio improving toward 99% as filed rate increases begin converting to earned premiums on policy renewals.
Here is how the rate-earn dynamic works. When a regulator approves a 12% auto rate increase, it does not immediately translate to higher revenue. Policies renew on their anniversary dates. A January approval shows up gradually over the next 12 months, as each policy comes up for renewal at the new authorized rate. The typical earn-through period is 9 to 15 months from approval to full recognition in earned premiums.
CINF has been filing and winning personal auto rate approvals across key states since late 2024. By Q1 2026, a meaningful portion of those approvals are earning through renewed policies generating higher premiums against a relatively stable claims baseline. If the trend continues, personal auto should improve from above 99 toward a 96 to 97 combined ratio by year-end.
Commercial lines is the other half of the pricing story, and here the market is actively working in CNF's favor. Commercial property and liability rate increases of 6 to 8% on renewal are flowing through with minimal new capacity competition. Specialty and excess surplus lines, where CNF has been quietly building a meaningful book, are seeing even firmer pricing as admitted carriers retreat from complex risks.
The forward EPS projection for Cincinnati Financial is where the math becomes compelling for patient investors. Street consensus for full year 2026 sits around $8.40. At $148, that is roughly 17.5 times forward earnings. Reasonable for a company growing earnings at 8 to 10% annually, backed by a 64-year dividend streak that provides an institutional floor under the multiple.
The more relevant valuation metric for insurance companies is price to book. CNF trades at 1.57 times book value. The historical range over the past decade has been 1.6 to 1.8 times. That puts the stock at a modest discount to its own historical average, unusual for a company that just delivered a 10% EPS beat in a tough catastrophe environment with a new CEO executing without any misstep.
The price-to-sales ratio of 2.35 times sits above the peer median, Travelers at 1.8, Allstate at 1.45, Chubb at 2.1. That premium reflects the dividend aristocrat valuation that income-focused mandates pay for certainty of income growth. But relative to CNF's own history, the current reading is near the low end of the recent 3-year range, not expensive on an absolute or relative basis.
Operating cash flow reached approximately $1.18 billion on a trailing 12-month basis. Free cash flow after minimal capital expenditures, insurance companies do not build factories, came in around $1.1 billion. That generation funds both the dividend and the buyback, while leaving room to grow the premium book organically without requiring external capital raises or drawing on credit facilities.
The options market reflects a defensively bullish posture on CINF. The put-to-call ratio sits at 0.55, well below 1, with call activity meaningfully outpacing put buying. July 150 calls are active with consistent volume. Put activity is minimal, suggesting limited downside concern from current holders. That is consistent with income-focused institutional ownership. Mandates that own CINF for yield and stability, not traders hunting volatility.
On insider activity, CEO Steve Spray purchased 5,000 shares at $143.20 in January 2026, his first open market buy since taking the top role. Board members have been making routine purchases under Rule 10b-5-1 plans. No significant insider selling in the prior 90 days. The insider signal is moderately positive. The CEO is putting personal capital to work at current prices.
Steve Spray succeeded longtime CEO Steve Johnston in 2025, having spent his entire career inside Cincinnati Financial in underwriting and field leadership roles. That career path matters. Spray knows the independent agent relationships personally. He has signaled continuity. No dramatic strategic pivots, no move toward direct distribution, no acquisitions to inflate premium volume. The culture that built the 64-year streak is intact.
The independent agent model Cincinnati Financial operates is genuinely difficult to replicate. Independent agents hold appointments with multiple carriers simultaneously. Every renewal and every new client is a choice of which carrier to recommend. CNF wins that recommendation by being known as the carrier that pays claims fairly, pays quickly, and does not create friction for agents or policyholders in the moments that matter most.
That reputation takes decades to build and is nearly impossible to acquire. You cannot buy your way into the trust of 10,000 independent agents. You earn it one claims check at a time, one field representative conversation at a time. The moat that keeps agents choosing CINF over a competitor offering a slightly higher commission schedule is what makes premium growth durable through any pricing environment.
Consider the beta on this name, 0.62 against the broad market. CNF historically moves about 62 cents for every dollar the S&P 500 moves. In risk-off environments, rising rates, economic uncertainty, equity volatility, low beta quality dividend names attract capital rotation. CNF is structurally positioned for the kind of flight to quality that income investors pursue when macro visibility narrows.
Return on equity for Q1 annualizes to approximately 11.5%. For an insurer running below 100 combined ratio and generating 13% investment income growth simultaneously, that ROE is solid and consistent. Insurance is a compounding business. You do not need 25% ROE if you compound at 11% for 64 years while raising the dividend every single year without exception.
The market cap stands at $22.6 billion, supporting a workforce of approximately 6,100 employees. That revenue per employee ratio is well above the P&C industry average, reflecting both the asset-light distribution model and the productivity that accumulates from long-tenured field staff and stable agency relationships. Low turnover at every level of the organization has measurable economic value that flows through to the combined ratio over time.
The analyst community carries a consensus hold, with 17 analysts covering the name. 6 are at buy. The consensus price target is $162, 9.5% upside from current prices. Add the 2.4% dividend yield, and the 12-month expected total return is roughly 12% if the stock simply grows to analyst consensus. A reasonable setup that requires no heroic assumptions about multiple expansion.
The trailing PE of 14.1 times looks attractive in context. EV to EBITDA of 14 times is reasonable for a franchise with this earnings consistency and dividend longevity. These are not distressed value metrics. CINF has always commanded some premium for reliability, but they are not stretched valuations either, particularly with the stock sitting near the low end of its recent historical price-to-book range.
Revenue growth of 8.4% year over year reflects both pricing and volume. Commercial rate increases of 6 to 8% and personal auto increases of 10 to 15% in key states are flowing through earned premiums. On volume, the independent agent channel is generating consistent new business wins as agents consolidate toward carriers with superior claims track records and financial strength ratings to show their clients.
Now let's benchmark CINF against rivals, including Travelers, Allstate, and Chubb. On price to sales, Chubb at 2.1, CINF at 2.35, Travelers at 1.8, Allstate at 1.45. Cincinnati Financial commands a premium to Travelers and Allstate. That differential is the dividend aristocrat premium, historically justified by superior dividend consistency and underwriting discipline across full insurance market cycles.
On revenue growth, Allstate leads at 9.8%, CINF second at 8.4%, Travelers at 7.2%, Chubb at 6.5%. Cincinnati Financial sits in the second position, fast enough to reflect real pricing and market share momentum, not so fast that it raises questions about underwriting standards being stretched to chase premium volume at the expense of loss ratio discipline.
The most meaningful peer comparison is on combined ratio. While final Q1 numbers from all peers are still being reported, CNF's 96.8 in a high catastrophe quarter is genuinely strong. The independent agent model, with its built-in selection discipline, tends to produce better underwriting outcomes than mass-market direct carriers that compete primarily on price and absorb more adverse selection over time.
The dividend comparison is where CNF separates from the peer group entirely. Travelers yields about 2.1% with consistent but non-aristocrat level growth. Allstate yields around 2.7% but has a history of suspension and cuts. Chubb yields about 1.5%. None of them have 64 consecutive years of dividend increases. The consistency premium CNF commands is not arbitrary. It is earned over 7 decades of follow-through.
Catalyst 1. Personal auto rate approvals continue earning through in 2026. As filed increases convert to earned premiums on renewals, the personal lines combined ratio should improve from 99 plus toward 96 or below. That improvement would be a material operating earnings tailwind and could trigger re-rating toward the high end of the historical 1.6 to 1.8 price-to-book range.
Catalyst 2. Fixed income reinvestment compounding. $30 to $40 million in annual investment income growth as legacy low-rate bonds roll off is a multi-year tailwind with no execution risk. It does not depend on the economy, on weather, or on competitor behavior. Bonds mature, cash flows in, reinvested at 5% plus yields versus 3 to 4% rates when those bonds were originally purchased. Pure math, compounding forward.
Catalyst 3. Hard commercial lines market persisting through 2026. Commercial property and liability rate increases of 6 to 8% on renewal are expanding the underwriting margin cushion. If those rates hold through the second and third quarter renewal seasons, which tends to happen when reinsurance costs remain elevated after active catastrophe years, Cincinnati Financial's commercial book will see significant margin improvement on an expanding premium base.
Catalyst 4, the 64th consecutive dividend increase, solidifies aristocrat status and attracts incremental institutional demand. Income-focused mandates, pension funds, endowments, dividend ETFs, explicitly require aristocrat membership for portfolio inclusion. Every year CINF maintains the streak, it reinforces its eligibility for those mandates and creates structural buying demand independent of fundamental performance in any given quarter.
Risk 1. Weather. A major hurricane or multi-catastrophe season in the second half of 2026 could push CNF's full-year combined ratio above 100%, producing an operating loss quarter and triggering multiple compression in an income-sensitive stock where investors have historically priced in reliable underwriting profitability. Atlantic hurricane season forecasts are elevated for 2026. That risk is real and season-dependent.
Risk 2. The equity portfolio. The $12 billion plus in concentrated, long-held equity positions creates book value sensitivity to market corrections. A 20% equity drawdown would reduce book value by approximately $1.5 billion, compressing the price-to-book multiple and theoretically limiting dividend growth capacity. Though at a 34% payout ratio, Cincinnati Financial has enormous buffer before the dividend itself would face any meaningful stress.
Risk 3. Competitive pressure in personal lines. Allstate and Progressive have deployed sophisticated real-time pricing models that allow more precise identification of profitable business. If those carriers begin offering superior economics to independent agents, higher commissions, faster quote-to-bind workflows, better digital tools, CNF's wallet share in personal auto could gradually erode over a multi-year period as agents optimize toward carrier technology platforms.
Risk 4. Social inflation in commercial liability. Jury awards in commercial liability cases have been rising above actuarial expectations nationally, driven by plaintiff litigation tactics, changes in jury composition, and the growth of third-party litigation funding. If loss ratios tick upward in 2026 due to social inflation, that could pressure the combined ratio in the very segment that is currently benefiting most from hard market pricing momentum.
The key metric to watch is the Q2 2026 combined ratio. Summer storm activity in the Midwest and Southeast determines whether CNF can sustain sub-97 performance through the second quarter. A combined ratio below 96 in Q2, benign weather plus continued personal auto improvement, would be the confirmation that the full-year underwriting quality thesis is on track for a meaningful earnings beat and potential re-rating.
The bull case. If Q2 delivers a combined ratio below 96, investment income continues compounding at 10 to 13%, and personal auto completes its rate earn cycle by Q3, analysts would likely revise full-year EPS estimates toward $9 or above. At 1.7 times book value, the midpoint of the historical range, that scenario supports a target in the 170 to 180 range, 15 to 20% upside from current levels.
The dividend aristocrat compounding mathematics bear repeating because they are central to how CINF is valued by its core institutional base. A buyer in 2015 who paid $85 has watched the annual dividend grow from $2.40 to $3.60. A 50% increase in the income stream. Their yield on cost today is 4.2% on that original $85 basis, and rising every year.
That is the income compounding story that drives long-term ownership of dividend aristocrats. The entry yield is secondary to the trajectory. A 2.4% yield today, growing at 7% annually, becomes 4.7% yield in 10 years and 9.3% in 20 years on the original purchase price. For endowments and pension funds with multi-decade horizons, that arc is more valuable than a higher static yield from a non-growing source.
Valuation summary. CNF at $148 trades at 1.57 times book, modestly below the historical 1.6 to 1.8 range. Forward PE of roughly 17.5 times is fair for the growth and consistency profile. The 2.43% dividend yield provides an income floor backed by 64 years of evidence. On total return, the setup is reasonable for patient, long-duration capital with an income orientation.
What we are watching in the second half. First, the Atlantic hurricane season. Above-average activity would be a near-term headwind. Second, Q2 combined ratio as underwriting quality confirmation. Third, investment income trajectory and reinvestment pace. Fourth, any management commentary on commercial pricing durability, specifically whether 6 to 8% renewal rate increases are holding or beginning to soften under emerging competitive pressure from new underwriting capacity.
Cincinnati Financial is not a stock that attracts momentum traders or growth investors chasing 30% annual compounding. It attracts patient capital that values dividend reliability, underwriting discipline, and the long-term compounding that comes from reinvesting a growing income stream for decades. Steve Spray's first full quarter as CEO was a quiet, confident affirmation that the culture and the discipline that built the 64-year streak are fully intact.
Charged Alpha is for informational and entertainment purposes only. Nothing we discuss is financial advice, and nothing should be interpreted as a recommendation to buy, sell, or hold any security. Investing involves risk, including the potential loss of principal. Always do your own research and consult a qualified financial professional before making any investment decisions. Charged Alpha is an independent production not affiliated with any company mentioned in this episode.
That is our deep dive on Cincinnati Financial, ticker CINF, Q1 2026 earnings, 64 consecutive dividend increases, a 10.3% operating EPS beat in a tough catastrophe quarter, and a new CEO off to a strong start. If you found this useful, subscribe and leave us a review wherever you listen. We will be back with the next name shortly. Until then, stay informed and stay charged.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.